Oh, good to see you. Good to see you. FOMC React Day. I was just about to do this offline. I don't miss an FOMC, but usually I watch them offline. But since the last one we watched on stream was so much fun, I figured I'd do it again. So it'll be starting here in just 2 minutes. 2 minutes, the FOMC. We already know the result, which is another rate cut. Again, the government can raise or lower interest rates to either slow down or speed up the economy, as it were, which is just raising and lowering borrowing costs. Today they lowered. They continue to lower, which is what Trump has been asking for nonstop. I wouldn't say asking. He's been screaming for it. He's been calling him too late, Powell. He's been demanding it. And Jerome Powell cut yet again another quarter point. So we know it's going to happen, but what we don't know is what he will say as to why. The real interesting thing about today's FOMC is that they're doing it in the dark. I don't know if you can read the title, but because the government is now on day 28 of the shutdown, we don't have a Bureau of Labor Statistics. We don't have a BLS. Nobody's publishing the employment numbers. We don't know. Everything is in the dark. There's no data. So normally very data-dependent Jerome Powell, who always answers the question by saying we're going to follow the data, is going to have to answer, and I'm sure he has some of his own data, but he's going to have to answer as to why they are continuing to cut, why aren't they holding? And that'll be interesting. That'll be something I want to know. So we're going to go to that pretty soon here. How am I feeling? I'm feeling pretty good. I'm feeling pretty good. Oh, and here we are. No home Jerome. Everyone ready? How's everybody doing? How's everybody doing? Finally, you're streaming on a time I can watch in Kazakhstan. Okay. Whoa, look at that aura. Look at it. Purple tie. He respects both sides. How about that? A true man of the people.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate
the
goals
dual mandate
of maximum employment and stable prices for the benefit of the American people.
Yeah, great.
Although some important federal government data have been delayed due to the shutdown,
Oh, yeah, okay.
public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September.
I see.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated.
You see it gradually cooling.
In
wish I
support
could
of our
pause,
goals
bro.
and in light of the balance of risks to employment and inflation,
Is there a YouTube version of
today,
this?
the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing GDP rose at a 1.6% pace in the first half of the year.
Bro, I
down
can
from
pause with this.
2.4%
How about
last
this? Wait, go back.
We also decided to conclude the reduction of our aggregate securities holdings as of
Perfect.
December
Now
1.
I can fucking pause.
I will have more to say about monetary policy after
Okay,
briefly.
wait. So right off the bat, what did he say? He said we don't have a lot of data, but based on the private data we have, the labor market's still cooling, which is, I would say, he said gradually cooling, which I would say is an understatement, because we're getting like these massive layoff reports. Let me see. We got UPS, 48,000 layoffs. Amazon, 30,000 layoffs. Intel, 24,000 layoffs. Nestle, 16,000. Accenture, 11,000. Ford, 11,000. Novo Nordisk is not really American. Microsoft, 7,000. PwC, 5,600. These are all recent layoff announcements. So,
reviewing economic
yeah, it is
developments.
cooling, and I could see the need to cut.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains
Data
weak.
centers.
The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends.
This is
In
the
the
big
labor
question.
market, the
I guess I'll
unemployment
pause
rate
on that.
remained
So we're going to do a video on the government shutdown in 2 days if it hits 30 days, because 30 days would be an incredible marker for a government shutdown. That's when things really start to break. After 30 days, you know, a lot of people stop showing up for work, including many air traffic controllers. That's the time when it needs to get solved. I think even the longest one only lasted 34 days. After around 30, like the pressure is so immense. So we'll cover that, but I guess for now it is not severely damaging, though it is damaging.
relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well.
Clearly.
Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline.
Right.
In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal.
I just want to, I'm listening. I know what you're trying to do. I'm just trying to balance the fucking, he's trying to keep stability. I get it. I know Jerome Powell's game. I know what you got to do. You got to dual mandate. But to cut through what he's saying, bro, it's like labor market getting worse, inflation still well above 2%, like around, we're at 3 something. And because you're cutting rates into inflation, it's not going to go down. It can only go up. At best, it would stay the same at 3%. So, you know, it's like giving up on inflation, and we're cutting fast to try and hopefully stem the tide of job losses.
Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures.
Okay.
Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
Okay.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Bro, put some
At
passion
today's
into
meeting,
it, Jerome.
the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3 3/4 to 4%.
Okay, so we're back at,
Higher tariff.
you know, if you guys were, here, I wonder if we have a chart. We have a chart, interest rate chart, USA. Can I get a 10-year? Yeah, okay. So we're like late 22. We're like late 2022 timeline on this. As you can see, we raised really, you know, we had inflation in 21. The government raised interest rates really fast to try and stop that. We held it higher for longer, he said. And now we're in a pretty rapid cutting cycle, it seems. So we're right about where we were, you know, November 22 on the way down.
Tariffs are pushing up prices in some categories of goods, resulting in higher overall
Bulk then
inflation.
cut. Yeah.
A reasonable base.
It's kind of like America was carb loading, you know, for a big bulk. And now we're cutting so we can show off our defined abs.
Case is that the effects on inflation will be relatively
that
short-lived,
makes sense.
a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and
This is the
that is a
part where
risk
he,
to be assessed and managed. Our obligation
He does some snide comments about tariffs. He doesn't want to be too direct, but he wants to show that he doesn't like tariffs. So he
is to ensure
He goes,
that
"Maybe
a one-time
they could be
increase in
bad."
the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside.
that's not good.
A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
Right.
Our framework calls for us to take a balanced approach in promoting both sides
But
of
you're
our
cutting.
mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments.
Okay.
We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
Yeah, get to the
We continue to
questions,
face
Jerome.
two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December.
Okay, let's pause on that. So if you know this FOMC thing, he's the chairman. He delivers the remarks. He makes the final call, but it's a vote. It's a debate. And I looked at the dot plots here, and we had a pretty big divergence. So we had this guy. Where did I put it? Where did I put right here? Jeffrey Schmidt. This guy from Kansas, he said, hey, we need to keep interest rates flat. Inflation's a problem. We need to keep them as is, no cut. He voted for that. This guy, Stephen, what was his name, Mirren? Is this Stephen Mirren? Make sure I got that right. Yeah, Stephen Mirren. This is the guy that Trump wants probably to be the next Fed chair after Jerome Powell. This guy said, we got to cut. We need to do a bigger cut, jumbo rate cut. This guy probably will be the guy that takes Jerome Powell's spot, unless it's Scott Bessent. He's angling for the job. He wants to be as pro-Trump as possible here. Red tie, you know? So in that, we got a middle ground. We got a 0.25 cut.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions.
Is this quantitative tightening and they're stopping it? Very, very, very short version is that we did quantitative easing post-COVID and post the Great Recession, where you basically print money to buy bonds to help stabilize the market. And then we were stopping that and reversing it. We were doing quantitative tightening. We were like letting those bonds run off of our balance sheet. And now that we're pausing that, it's a sign that we're probably going to go back to QE again. And again, QE is kind of like I want to make this understandable. It's a pretty insane thing. Like, it didn't exist realistically for America prior to 2009. And it is like a last resort kind of crazy, just fire up the money printer to flood liquidity into the market type thing. Now, we're not doing that now. We're doing the opposite, actually. But he just said we're stopping the opposite, which is a sign that we might restart QE.
Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates.
I just noticed. Why are they drinking fucking Aquafina? Everyone here, important economic writers, who get something better. Get a Fiji water. Was this like a branded Aquafina sponsor for the FOMC?
Moved up relative to our administered rates,
Aquafina's
and
gross.
we've seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%.
Yeah, but
in December, we'll enter the next phase of...
Let's get realistic about this, Jerome Powell. I appreciate what you're saying, but this is the balance sheet, okay? This is the amount they've purchased with printed money. You'll notice essentially nothing. Then great financial crisis. Then we've been QEing pretty much nonstop our whole goddamn lives. Then pandemic stimulus, it was fucking insane. And then they were like, all right, we're going to let this run off. And they've done $2 trillion of runoff to get us back to where we were, like basically here. And now they're stopping. So it's not like we're not even back to pre-COVID. Like, you know what I'm saying? Like this is, and now we're going to start again? So it's just, it's difficult to stomach.
Our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet.
Yeah.
The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation.
You think it's hard being Jerome Powell saying that same sentence 400 times every speech, all day, every day?
Sustainably to our 2% goal and keeping longer-term inflation expectations well anchored.
I get it.
Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
All right.
Thank you. I look forward
to
your
questions.
Nick.
What do we got?
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our 2 goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today.
Yep.
And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the 2 goals. For a very long time, the risk was clearly of higher inflation.
Yeah.
And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation.
Yeah, they were
We saw a very different picture of the labor
No,
market
didn't have
and suggested that there
numbers.
were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral.
Okay.
If the 2 goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today.
You do a 6.7?
But as I mentioned, going forward is a different thing.
Holy shit, is Jerome Powell based? Was he dropping a 6.7 on us?
Claire Jones, Financial Times. Thank you for taking this question.
He knows ball?
We've just heard from you that the
Sheesh, nice scarf.
the discussion in December
is that a money scarf? Does that say money? Does that have like an ATM and what is this fucking scarf, dude? Sheesh. She dripped out Slay Queen.
Conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's
Okay, wait. Her question is pretty good, right? So she basically said, like, okay, are you guys had a big debate over whether to cut this or not. Are you noticing the amount of our growth being driven by AI spend, AI boom, the rising stocks from AI causing people to feel like they have a strong wealth effect? Again, if you're somebody who's got, I don't know, S&P 500 or NVIDIA in your portfolio, you're feeling pretty flush. You go spend, take a vacation you wouldn't normally take. That type of top of the K spending is keeping things afloat. So
that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say.
I mean, just to be clear, I don't give a fuck. Tell me what you think, Jerome Powell. I mean, he's giving me a speech that people are different. People are different, Some people have a high risk tolerance. Some people have I don't care. You're just telling me that a lot of people think differently on this. I want to know
that
what your stance is, what you see from the data.
We haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen.
He did kind of move markets. So again, he keeps saying that we're not committed to December. We don't know. Don't bet on it. And the odds of a rate cut in December went from 90% to 75%. He's trying to, they call it jawboning, where you try to use just the power of words to influence the market to be more neutral here. It's Fed jawboning. And he's trying to convince people that it's not already guaranteed they're going to keep cutting, but it does seem like they're going to.
Higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
New question.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market.
Yeah.
But if those don't materialize,
They
and the labor
materialized.
market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about?
This is a stupid fucking question. This is a stupid fucking question. I'm sorry. I'm sorry, New York Times. This is a stupid question. Okay? He's just going to answer, yeah, well, if the data changes so that the unemployment rate's getting better, then yeah, we'll respond with rates to the upside. It's fucking obvious. He's made it so fucking clear that he's just going to, if the labor market gets better, then he will shift towards inflation and they will raise
Underlying
rates.
inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Yeah.
Steve.
I feel like I could do this job.
Steve
At this point.
Leisman.
I'm going to be honest with you. I actually have great respect for Jerome Powell and the tenacity you need to withstand the pressure. But this job of doing this speech is so easy. You just say dual mandate. We're going to be data dependent. You respond to every question that way. It's so fucking easy. It's like not.
CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had
Like a
dissents
pirate.
on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining
You don't even
quickly
have
in
the
any case.
data,
It may be
bro.
just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December
Yes.
1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills. which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're
I'm getting
managing.
shrinkage
that has
right
to
now,
be
Jerome
ample.
Powell.
So that'll happen for a time, but not a tremendously long time. We don't know
We
exactly
need a
how
dual
long.
mandate.
But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be, right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
John L.
Again, I mean, this gets a little in the weeds, but what he's saying is that when the government funds itself right now, we're doing it with short-term IOUs. Very simply, okay? We're borrowing money constantly on short-term, 6-month, 1-year bills. And the balance sheet of the Fed is more long-term stuff. That's when they bought it. And they are going to shift more towards buying the composition that we're trying to fund ourselves with. So it's taking some of that printed money to fund our own liabilities.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
What are these questions? He already answered that. He answered that 7 times. I'm losing my mind. What are these questions? It's like you fucking put it into ChatGPT. He answered that. That was the only thing he answered. My God, yes, there's a risk to upside for inflation, but also a risk to downside for employment. He sees the downside to employment as a greater risk, so they're cutting. That, of course, that's the only, ask anything else.
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the 3 components. So basically, you've seen goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
I like that because that was the first time I've ever seen Jerome Powell do a little
Stubborn in
well, don't get
services
crazy with
inflation.
it.
What are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
Dude, the fucking confidence to say that maybe in the future, if we keep cutting rates, we might have an excess of AI investment. Maybe someday we might get to a time when we have an excess of AI investment if you cut.
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data?
Yeah,
Thank
what
you.
are you?
So it's a lot of things, and it doesn't replace government
Dude,
data.
it'd be great if you just said, I've been going to the grocery store. I don't have government data anymore, so I've just been walking around. Shit's pricey, bro. I try to buy eggs.
But you know all of these.
Trust your gut.
I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Shut down.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do.
I mean, he's probably right.
If you ask me,
Everyone's saying Pepe laugh. Realistically, this government shutdown should end, honestly, within a week. Quote me right now. If we flash forward 1 week and this shit's still going on, it's fucking crisis, bro. Like because that'll be what, 35 days? It'll be full on the longest one ever per Atrioc. I want this clip to be flash forward in 6 months, and we're in the longest government shutdown in history. We're roving the streets like bandits. Because how many days are we at now? It's like, I think it's 28 as of today. 34, 35 would be the longest, so about 1 week from today. So yeah, 1 week would be a tie. If it goes past that, man, I wouldn't be shocked, I guess, given the political dynamics, but I would be worried because that's when the effects become very, very, very real.
could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow.
I'm also supposed to fucking fly to Japan in like 2 weeks or something. If they don't solve it, there's going to be no air traffic controllers for me to go. I'm not flying at that point. Dude, I heard air traffic controllers are getting like second jobs driving Uber. It's crazy. It's crazy. I don't want my fucking ATC to do an 8-hour Uber shift and then get on the fucking 10-hour shift, making my life in his hands. It's absurd.
Down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
Jerome Powell's long-term girlfriend asking him, "What are we?"
It's to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others.
Yeah.
Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment.
Yeah.
And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially.
Fucking preach, brother. Answer that, Jerome.
Started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. Yeah. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. Yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it.
I was just going to say, what a stupid statement, Jerome Powell. You know that. You know that it wouldn't show up in the initial claims data yet. That's a lagging indicator. You know that, and what the fucking response?
Claims data yet.
By the way, we don't even have data.
Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully.
Like what? That's crazy. That's crazy. That's like being in a plane going down and being like, "Well, listen, we haven't seen this show up on Wikipedia yet." It's like, yeah, it won't show up till afterwards, bro. And yeah, but I'm checking. I'm monitoring very closely.
But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there,
Yep.
and that consumers at the lower end are struggling
Yeah.
and buying less and shifting to lower cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Bro, I have to say it. I'm never gonna be able to find this. Atrioc K-shaped economy Reddit. Look at this fucking thing. This is a year ago. I remember this person writing a fucking wait, I can't. Atrioc K-shaped economy Reddit. This guy wrote a fucking novel. Look at this fucking novel, dude. Look at this fucking novel. And it's insane. There's so many annoying people on Reddit that'll write this fucking shit. And now, because I say it early. I say it fucking early when the data's already showing it. And now it's like openly admitted to in the Federal Reserve meeting. It's ridiculous. It's like, where do these people come from? It's like fucking first-year finance students writing horse shit. And I gotta hear this, and people in the comments are like, well, I don't know. It's a long post. It's a long fucking post. It looks like he really knows what he's talking about.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspective is of people on the committee that, we've now moved 150 basis points and that we're down into
Can we get some streamers in here? I'm sorry. Can I get some questions? Can XQC get some questions? Can we get some streamers in the room? These questions are trash. They're trashed. Get Aiden Ross in here. Get Asmongold in here. Okay? Get Justin Bieber in here. He's a streamer now.
you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above
We need DJ
the
Toenail's opinion on
median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market,
TTS.
or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, we've cut 50 more basis points in the last 2 meetings. And
We got a lore drop? We got a fucking lore drop? That's so sick. Hell yeah. The lore is that the labor market's a better reader of the economy than spending. And the labor market, he says, is doing poorly, or at least as higher risk to the downside. I mean, I would agree with that.
there was a sense like, from some, let's pause here kind of thing. And a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to
It feels
the different,
like
to do.
this is a fucking dog and pony show. I'm sorry. I've watched enough of these. They're asking questions they should already know the answer to. They should already be able to get, like, you come to every one of these. You're a reporter that comes to every one of these. You know what he's going to say before you say it. We're all just filling time.
Variables, which is common through, through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function.
This is crazy. I'm not saying that wouldn't have an impact, but Amazon is not laying off 30,000 white collar jobs because there's fewer immigrants. Wait! I mean, you just said that the demand is down more than the supply.
Of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in, February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation.
Bro. Donald Trump is already negative 31 on inflation. It is his least popular position. It is the thing he is most unpopular on. And you are telling me that tariffs will continue to cause inflation through this year, likely into the next. I mean, it's like, this is, people are already not happy.
2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices.
He's not wrong, right? He's not wrong with the theory. It's just so annoying to hear as a consumer, as like a regular person. It's annoying to hear that. Because for you, it's like, okay, well, it's still a more expensive thing that I'm buying. It just is not. Again, he didn't make the tariffs. He's actually against the tariff. I'm not blaming him. It's just, and then the second part of it is like the implicit assumption that Donald Trump is a guy who is just done with tariffs at some point. Whereas every indication shows that he's willing and able to throw new tariffs out at any moment. Like on Canada, there was a bad ad during the Blue Jays Toronto game, the Blue Jays Dodgers game. Canada ran an ad making fun of Trump, and he did another 10% tariff on them. Like, it's not like it's like, oh, this is a credible policy that has a certain tariff level that's going to stay the same and will be done, which would be bad enough. It's like more all the time.
Stop going up. They'll just be at that.
We had a 100% tariff on China come out of like nowhere, out of the blue recently. Hopefully that gets negotiated down, but it's the idea, it's not just, well, there's a one time and it's over.
And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story.
Okay,
their price.
Okay, good answer. I cut you off. My bad. Actually, my bad, Jerome. I didn't know you were getting to it. And I want to apologize. I cut you off. I got too mad. I got too heated. I didn't think you weren't listening. I thought you weren't listening. No, it's like opposite of pre-washed. I thought he wasn't going to mention the regular consumers, and he did, and I'll let him speak.
Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part.
Okay, honestly, this is the first time I've ever heard Jerome Powell say this, so I give him credit. Somebody told you, because you're a rich man, and I appreciate what you've been doing, but somebody finally told you that, that is how regular people see it, and I'm glad you mentioned it. Because, it's fucking crazy. It's ridiculous. I mean, again, I can't overstate this enough. Inflation, the number one thing at exit polls in this last election, the number one thing. People fucking hated the inflation in 21, 22, and 23. They hated it. When they go to fucking McDonald's or the grocery store and shit is more expensive than their mental model, they get pissed. It's frustrating. It's demoralizing. It's demeaning. And so the idea that not only has it not fucking stopped, but it's keep continuing, and with the tariffs rising, is anger inducing.
Why the public, if you sample people, inflation is still very much making people quite unhappy.
You didn't go band for band with J-Powell? I think J-Powell's worth $100 million. I'm not kidding. Jerome Powell net worth. Oh, wait, no, wait. What, excuse me? It's a pretty big range. The little AI overview on Google says his net worth is between 4.7 million and 55 million. That's fucking huge. That's like, a decent house in Los Angeles, or your fucking a massive business owner. That's crazy.
Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael Pickey from Bloomberg Television and Radio.
He's got Yiddish money.
Do you have any concerns that equity markets are or are close to being overvalued at this point?
He won't answer, but
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an over.
Well, I'd push back on that a little bit, Jerome Powell, in that in the banking system, they're hiding rising defaults. I did a presentation on that. Maybe I'll do a clip. But also, a lot of it's in private credit, in this opaque black box of lending that you don't have insight into. I don't have insight into. Wall Street doesn't have insight to. Nobody knows the risks of private credit. But we've already seen some blow-ups. And in the words of Jamie Dimon, where there's one cockroach, there's usually more.
Overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here.
I mean, listen, they think they will eventually make money on them, but they're not making a lot of money. None of them are making money. Nobody's making money building a data center right now.
There. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs.
I'm sorry, buying.
Right? So
the
we're here
by
lowering rates.
That's true.
At the margin, that will support demand.
Yeah,
and that will support more hiring. And that's why we do it.
Well, unpaid, though.
No 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But
it's a hard job, damn it.
Because there's uncertainty around inflation and the path ahead for inflation. That's why we're going. That's why the pace we're going has been a careful one.
Victoria.
What question you got, Victoria?
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Damn.
Yeah, this is different.
Damn, she just said, is this a dot-com bubble or not? Or nah. Jay Powell, is this a dot-com? We got ourselves a little dot-com bubble here?
Different. in the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies. And, so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and, it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in.
Look, I mean, he's right in that a company like NVIDIA is printing cash hand over fist. It's raw, it's real. They got profits on profits. They take a fucking bunch of fucking silicon. They have it made in Taiwan for a few $1,000. They sell it for 50 grand. And they do that over and over and over again. Every single one they make, they sell. It's profit. It's green. It's cash. I get it. But the companies fueling that demand aren't making profit on it. The one I'm thinking about the most is OpenAI, which is at the heart of this whole damn thing. OpenAI isn't making any money yet. And it all comes back to OpenAI. They're the ones promising all the money to get everybody to buy all these chips. The money has to get made.
Equipment and all those things that go into creating data centers and feeding the AI. It's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on.
Okay, but come on. Come on, bro.
AI, you could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped.
I heard your supply
very,
of workers
very
story.
sharply due to mainly immigration, but also lower labor force participation. So, and that.
Would you perhaps admit, Jerome Powell, that lower labor force participation is people at the lower end of the economy deciding there are no good jobs, so I'm going to drop out of looking? I would rather not try for a job when I know the only options I have are barely worth what, unemployment pays me. Like, it's not that dropout of the labor force is in response to opportunity and not like a random choice.
That means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of...
It's so fucking backwards, and I think he knows. This line of argument makes no sense. People don't create jobs because there's people there that need them. It's like companies aren't like, oh, there's a bunch of new people that need jobs, let me make jobs for them. That's not why they do it. It's not... I can see how, spending by immigrants could support the creation of new jobs. I could see some part of that. And if you remove people, it could slow down growth. But the way he's framing it is ass backwards from that.
Of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But
of course,
you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind? Or
this is because this guy wrote this question before he got here. That's what I'm noticing. This guy doesn't know fuck all. Wrote his question before he got here. It's already been answered 4 times. And now he's going to read it. He's just going to fucking grab the mic and read it. So he did something. But nobody cares. He already answered it. He already answered what he's going to do.
Does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right, that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting, we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago, you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Interesting answer, actually, because of how uninteresting it was. A little context is that, I remember forgetting the name, these Basel III plans or whatever. Jerome Powell used to be bigger on, quantitative tightening and getting a lot of this money back out of the system that was added after COVID. And now he seems like he's really evasive on that, knowing that it would, cause the economy to probably tank, at least short term. So, interesting.
Right.
Hi, Chairman Powell. Brian Chung with NBC News.
All right, Brian.
Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs.
All right, look, initial claims, it's true. You're not seeing anything crazy in initial claims. This is a little bit out of date, but it still holds true today. But you could find the more recent one. I'm going to show this now. But where you do see it, which he's talking about initial claims, but he's not talking about, I can't fucking pull this tab up. He's not talking about continuing claims, okay? People that are like 90 days plus unemployed. What is the date cutoff for becoming continuing claims? It just keeps rising. It's steady and keeps rising. People are out of work and continually out of work. They can't find a job. So, and he just keeps bringing up initial.
Or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years.
And again, all of this is in an environment where people aren't hiring, yes, but not really doing a lot of firing. But if that turns into a big layoff wave, now I won't say we're there yet, but we did have a bunch of layoffs announced very recently, as was mentioned in this conference. The Amazon layoffs, the UPS layoffs, the PricewaterhouseCoopers layoffs. Like these other layoffs are sending a signal, right? There's not like a 50,000 hiring going on, but there's a 50,000 firing. So if it turns into a no hire, lots of fire economy, that would be a surge.
There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Yeah, he's right. That's true.
Hi, Chair Powell, Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Reading into that a little bit, it seems to imply that process will take place of reappointing or choosing the Fed governors, the 12 of them that do the vote, before Jerome Powell gets kicked out in May. He said February very specifically, and he said, I'm going to do it in a timely way. So reading into that statement, it's like, hey, I'm going to make sure to stack the deck of Fed governors in a way that follows the interest plan I want and not give Trump the power to kick me out and then reappoint all the governors. That's pretty interesting. I could be misreading this, though. I don't know the exact rules. I don't know if he could force through 12 things in a small period, but that's an interesting answer.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions. And you've just mentioned there's strong disagreement over the future path of rate cuts.
His name is Daniel LaFrance? That can't be right. No, it's Daniel Avis, okay. I thought this guy was fucking... okay, all right. I thought his... Okay, all right. Never mind. I'm sorry, but he is French.
Meeting you had dissents going in France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that. No, I think
it's healthy.
You have to take what comes, and what comes right now is pretty challenging situation where we have. First of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so. It's a challenging thing. And
I honestly feel like Jerome Powell didn't understand his question because of the accent and is just repeating his stock speech. I feel like Jerome Powell was like, well, you said fucking baguette. I'm just going to do the dual mandate fucking day one. There doesn't even,
you know, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, you know, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people.
right,
But they
hell
have
yeah.
different views on what that is. And, you know, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. You know, I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, you know, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under you know, quite challenging circumstances and doing the best we can.
Your job's hard. I agree.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning
question.
So, you know, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. You know, we're looking at it carefully. We're paying close attention.
Okay. But isn't it kind of fucking annoying, Jerome, that like when you're talking about the economy, you don't mention any of this stuff. And then when someone asks you about it, you go, yeah, we're aware of that and watching it closely, but you just decided not to mention it. It's like it's like the third time in this meeting someone has brought up like a pretty significant narrative violation. And you go, yes, of course. I'm aware of that. We're watching that closely, but we don't, you know, it's like, okay, I understand that all the facts aren't out yet, but it's like a pretty important thing to watch.
I don't see
y'all
at this
didn't
point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But, you know, we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many.
I'm not saying this will happen. But that sounds exactly like former Fed Chair Ben Bernanke. Can I watch this still? Does this still exist? God, I wish I could find it. I have the quote, but I can't find the video. It's just Ben Bernanke saying, we believe the effects of troubles in the subprime sector are limited. We don't expect any spillovers to the rest of the economy or the financial system. They're all contained. You know? That it just sounds exactly the same. So, you know, it's hard to trust, bro. It's not, again, I do agree. I'm being a little bit of a dickling right now. I do agree. Obviously, subprime auto is smaller than subprime housing in 2007. I'm just saying, like, you're using the same verbiage and language, and we have no idea how extensive this is because it's all private. It's all hidden. It's all these companies that made so many loans and we have no insight into the books. What does subprime mean? It means loans to people that are not good, don't have good credit. That's the best way to put it. A subprime loan, like a subprime auto loan we're talking about right now, is like giving a huge car payment to someone who clearly can't pay it off. But writing it on in your books like as if it's a fucking perfectly healthy loan. It also means that you should subscribe with Prime. So if you're watching, what Jerome Powell's trying to say is check right now the purple button and see if you have a Prime subscription. Because if you use that, you help support the content to get more financial news coverage like this. For example, I think Jerome Powell, if he were here, would say thank you to Empty Hex for giving me a Prime, to Twitchy Shell for the Prime, for Galen CN for Triple Threat AIMD, adding username Risky Bacon Freedy 321123. I'm Moon Fergie Fish Shovel 1708. Thank you so much for the Primes, and I appreciate Jerome Powell for that call to action. Redono, thank you for the Prime. Seb Mitch, thank you for the gifties. Cognition, thank you for the Prime. Zomoth, thank you for the Prime. Darkish Rainbow. Andreas BN04, thank you for the Prime. Samaki92, thank you for the Prime. Jehogi, thank you so much. The economy's never been stronger, folks. I feel it right now with these Primes. That's a true subprime economy.
You yourself.
And making sure that that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong in some odd way?
These are the two best questions so far. Who is this woman? I'm going to follow her on social media. This is the two best questions. What is she writing for Yahoo? She's at Yahoo Finance. I need to find out her name.
It's close to going up.
Or the outlook for looking at one-time auto loans.
Jennifer Schonberger at Yahoo Finance. Jennifer Schonberger, Yahoo Finance. Great. Okay. Followed. Maybe we can interview her. We can interview her for Big A, bro. I'm trying to. This is the only good questions today.
JP Morgan.
This is her name. Water is the case.
Right now, with high net worth individuals continuing to spend with the lower income pulling back.
Okay.
How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But and you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Damn, she got the one good question and he fucking dipped. That's the Schonberger difference, bro. Yahoo Finance just mogged all you fucking organizations. All right. Well, that was fun. That was fun to watch. Nothing too shocking, nothing too crazy. I think he was in line with what he said last time. To be fair, I think a cut is probably appropriate. I mean, that's not that crazy, although we'll see what they do in December. Some part of me wishes he would just fucking hold strong against inflation specifically, but that's because I don't fucking, it's easy for me to say. I'm not looking for a job. Guys and gals, I have to go record another podcast. I have to record a book club episode for the podcast. J.D. Vance's book, Hillbilly Elegy. I have to go record. So I'll have to head out here. You guys you're saying boo, but I learned a lot from that book. I learned that it's not whether you're black or white that's the problem. It's whether you're poor. That's what I learned. I learned it's not really about race. It's whether or not, if you're poor, it's because you don't work very hard. And that was actually really powerful. That was actually really powerful. And so I will talk about it. Though I'll be honest with you, I read summaries, bro. I didn't read the book. I'll say it right now. It's my bad. I should have. I didn't have time. I've been reading a book that I've been reading the Squeaks in Chat. I Spark Notes this one. And I read some discussions on it. But I did not read it because I'm reading a book. I'm reading When Everyone Knows That Everyone Knows and 1929, both of which are pretty fascinating books. So I'm going to ask a lot of questions. I'm going to let them speak more than me. But, folks, appreciate you watching. Much love. I'm going to raid Stanzy. And I am not going to promise anything, but I should stream tonight. I don't know why I wouldn't. I don't have anything going on. Last night I went and saw a movie with my wife. I saw Weapons finally. It was good, but sad and depressing, and I didn't like it. It was a good movie. I like Zach Cregger. I don't know what the fucking love of Weapons was. It didn't even end nice. It was just strange. That's fine. Maybe I wanted a nice win. All right. Anyway, I'm rating Stans. Movie's good. It's like it was bad. It wasn't like mechanically bad. The acting was good. The horror was scary. The kills were gross, but I was like, why did I watch that? Anyway, I hope you enjoyed. Good to see you. Peace. They can't all be Harry Potter. Okay, bro. I just wish it was. I'm sorry. I wish it was. I wish every movie was Harry Potter. That would be awesome for me as a millennial. Goodbye.